Hi, my name is Jaxson Liening. I'm a sophomore studying computer science and mathematics. Today I'll be presenting my research on the effects of air pollution on investor behavior. All research was completed with Dr. Michael Price in the Culverhouse College of Business, Department of Finance, Economics, and Legal Studies. So the impetus of this research is, does the air we breathe affect the trades we make? And there's a lot of literature that shows that non-financial factors can impact financial markets, such as weather, which impacts investors' moods and subsequently shows up in asset pricing. Additionally, air pollution is a known stressor that impacts people's decision making by kind of impairing their ability to make rational decisions. So naturally this leads to the question, does exposure to ambient air pollution impact retail investors' trading decisions? So taking a brief look at the biological effects of pollutants, chronic exposure, which we define as prolonged throughout the course of a month, to O3 or ozone leads to neuroinflation or weakened inhibition and impulsivity. This affects the prefrontal cortex, weather, sunshine correlating with market returns, as well as specific pollutants impacting people's decision making. But there's kind of a gap in the financial literature between salient pollution events, so these spikes or shocks, consider something like a wildfire affecting someone's financial decision making. So this paper seeks to sit in that intersection, showing the impacts of environmental stressors on financial decision making. So the first step was to construct the data set, and I started with a Barber and Odean data set from 1991 to 1996 with around 4 million trades from 78,000 retail investor households. And then I took daily EPA monitor level records from the same time period for 4 key pollutants, as well as the temperature and wind speed from that day. And then you're faced with a pretty difficult computer science problem where you have to match each EPA monitor with the nearest household, or the nearest monitor for each household. And then through that, you're able to kind of construct an idea of what the pollution was like on the day that this trade was made. The next step, we construct an instrumental variable, or using wind vectors. So NOAA has hourly wind vector data from around 20,000 monitors across the United States. And this map kind of shows the distribution of these monitors as well as the EPA monitors. And we can kind of see how close to and far apart they are. We're looking specifically at NOAA monitors that are within 60 miles of an EPA monitor. And this kind of, the assumption for constructing this instrumental variable is that daily wind direction is randomly assigned, and that wind direction is random, and that it only affects financial markets through this instrument of pollution because wind carries pollution. And then how this looks in practice is, consider a factory that's kind of northwest of an EPA pollution monitor, and depending on the wind for that day, which is measured by the NOAA weather station, you can kind of see how different houses are impacted from this factory. So maybe if the wind is blowing southeast on one day, there's a house in the dirty sector, which we measure as having the largest concentration of pollution on that day. And then maybe a different day it's blowing east, and this marks a different house as in the dirty sector. So by doing this, you get a pretty good proxy for where these pollution-making things are, like a factory or a highway, and allows us to really see the impact of this pollution using the randomly assigned wind. And then the next step was to construct our variables. So these include exposure and behavior. And the independent variables here, if we want to see what this effect actually is, and if it's impacting retail investors, then we can't just look at the simple average of pollution throughout the course of a month. I think this is best shown through a case study. If you look at Santa Clara, California in 1994 and Pittsburgh, Pennsylvania in 1991, even though these are different months, they have the exact same average pollution. When looking at this chart, you can see that it's actually very different exposure to pollution just based on the spikes and the volatility in the pollution. So if there's actually an effect here that we want to measure, then we have to look at these 2 months differently. So we can do that through the spikes or the intensity, as well as the volatility or the standard deviation, and the number of days above a certain threshold or the EPA health threshold. And then we can measure the monthly trading frequency and the dollar volume, as well as portfolio turnover as defined by Barber and Odean. So the initial results looked at simple correlations using a two-way fixed effects model. And this controls for differences in households like income, number of children, each family's risk tolerance, as well as time effects, including general market volatility, seasonality, holidays, things that we just want to control for. And just looking at simple averages, the initial results were null. And you have to look a little bit deeper than that like I mentioned, with the spikes, volatility, and frequency, and these results were significant and shows that they strongly predict trading frequency and volume. And particularly ozone and sulfur dioxide emerged as these robust predictors. And seeing this effect, we knew there was something a little bit more here. So we began to look at measurement error, which intuitively, houses that are closest to the EPA monitor should have the most accurate pollution readings. So looking at the effect in different distance spins from how far it was from the EPA monitor, you can see that the effect is strongest nearest to the monitor and kind of tapers off past 10 miles. And this gave us confidence that this effect truly existed and we weren't just pulling it from random noise. So the next step was to include the instrumental variable and then upgrade to a two-stage least squares for a causal identification strategy. And this found, first of all, that wind is actually a strong predictor for air pollution because wind carries air pollution, and that it revealed a dual mechanism where chronic, so prolonged exposure throughout the month to O3 drove impulse buying, and acute exposure or daily exposure to SO2 led to increased trading activity. Overall, these coefficients were much larger than our OLS estimates, which shows that we were able to kind of mitigate this measurement error, as I mentioned on this slide, with the distance from the monitor. So looking at who is actually impacted by this, it shows we find that older investors are less susceptible to this effect. And this makes sense because their brains are more developed, they've been in the markets for longer, so perhaps they're able to kind of filter out this subconscious agitation or impulsivity that they may be experiencing from the air pollution. Additionally, wealth does not protect people. We find no evidence that wealth is able to protect people from this, and that high-income investors are just as susceptible as lower-income investors. And overall, this implies that it's a biological bias that money can't fix. Ultimately, humans are affected by pollution the same, regardless of how much money you have. And then looking at the financial consequences of this, we can calculate Jensen's alpha, which is the risk-adjusted market return for the stocks that were traded on high pollution days. And we find causal evidence that pollution leads to portfolio degradation and an average of around -4% annual risk-adjusted returns. Additionally, preliminary analysis shows no impact on broader market inefficiencies or prices. However, this is definitely an area of future study. So to conclude, we find no evidence that averages affect monthly trading, but looking at these salient events, we can find an effect. And overall, aggregation bias hides the true signal, but rigorous measurement kind of reveals the true effect, and this leads to higher market activity and lower portfolio returns. Future research will look into predictive models to determine if air pollution, or see if we can use forecasts or these shocks to kind of anticipate liquidity events, as well as looking to modernize the data in the online brokerage era. Robinhood do these more gamified systems kind of enhance this impulse mechanism. And with that, I'd like to open it for any questions. Yes?
Great talk. I'm very impressed you did this in one semester. Your heterogeneity results show that older investors are less likely to be affected by impulse buying, but your returns analysis show that all age cohorts posted roughly equal or negative returns. Why is this?
Yeah, so like Greg said, the heterogeneity results show that different ages are impacted differently, yet they experience around the same negative returns. And this, I think you really have to look at the market context in this time. This was the 1991 through 1996 data, and we were in kind of the dot-com boom. Internet was becoming huge. And what the risk-adjusted market returns really show is that investors weren't being compensated for the risk that they're taking. So maybe younger investors are purchasing these riskier assets like tech stocks, and maybe older investors are, panicking and selling their assets or staying in these less risky things. So they're kind of missing out on this general market bull run. So overall, they're just making worse asset decisions and what they're actually purchasing, which kind of affected their returns in a similar way. But you just have to look at the market context.
Yeah, I thought this was a great talk. You argue that pollution causes a pretty significant decline in risk-adjusted returns, but you also found that there was no evidence that this leads to pricing inefficiencies in the broad market. And if the effect of pollution is really so damaging, then why aren't we seeing it really reflected in asset prices across the market?
Yeah, so this looked at around 4 million trades in the 90s, and when there's millions of trades made every day, that's really not that large of a data set. So it's kind of hard to determine how much this is impacting the broader market, but that's definitely an area for future research. Additionally, as it currently stands, this would imply that wealth is just being transferred to institutions and that they're able to kind of capitalize on this behavioral bias that retail investors are facing, but possibly future research will show that this leads to general market inefficiencies rather than just a wealth transfer.
So you mentioned two different biological mechanisms, anxiety for sulfur dioxide and disinhibition for ozone, that operate on different time horizons. Is there medical literature to support such bifurcation, or is this fitting the narrative to the regression results?
Yeah, so some of the biology literature does show that this is a true effect and that they kind of impact each other on different, or impact humans on different time horizons. Particularly, sulfur dioxide can impact humans within hours of exposure, whereas you kind of have to build up this exposure to ozone across the course of a month, which is impacted or reflected in the results in our analysis. That is also an area of future research. Perhaps we are able to take measures of like biological measures or people's medical things of that nature and kind of implement that into our analysis in the data set in the future.